This is Business Weekend.
Hi and welcome to Business Weekend. I'm Edward Boyd. Coming up, Bank of England Governor Andrew Bailey says his economy is in recession and the US Federal Reserve admits the United States could fall into one too. We'll break down what that means for Australia with ANZ Bank Chief Economist Richard Yetsenga. Cash in decline, so does it have a future? We have a look at what the RBA is doing in response, as well as the merger between Australia's two largest cash transfer businesses, Armaguard and Prosegur. I sit down with veteran investor Robert Millner to try to understand his way of thinking and approach to markets. He's the chairman of a number of companies, including Soul Patts, Brickworks and New Hope.
I think going forward there's going to be some people hurt along the road. This is going to be a very major problem the world's going to face.
I'll then be joined by Shaw and Partners mining analyst Peter O'Connor to talk through some of the big moves in the mining space this week, including Fortescue's plans to decarbonise by 2030, Oz Minerals approving a new mine, and record high coal prices.
It's possible, and they're probably the company that could deliver that, but it's certainly going to be a challenging 7-year period to get there.
We'll also catch up with Taryn Gupta, the Chief Executive of property developer Stockland. The company, founded 70 years ago, started with just 19 fibro homes in Western Sydney, and it's grown to become Australia's largest listed residential property developer. That's all coming up on today's program.
And that affordable homes and shelter and a place to bring your family up in a community remains true to our purpose even today.
But first to our top story, and a lot can change in a week. 7 days ago, most Australian economists were expecting the Reserve Bank to lift interest rates by 25 basis points next month. Since then, we've had cash rate rises in the US and the UK, and the word recession is rearing its ugly head again. As of today, a majority of these Aussie economists are now expecting 50 basis points in October. Here is Jerome Powell, the chairman of the US Federal Reserve, talking recession risk.
For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be.
Joining me now on the set is Richard Yetsenga, Chief Economist at ANZ Bank. Richard, thanks for your time today. What are your expectations for the Reserve Bank's board meeting in October? Will we see 50 basis points?
I think so. Unfortunately, I think we'll see a continuation of the run of 50 basis point moves. The bank's spoken recently about maybe slowing down, but I think the strength in some of the survey indicators particularly, which suggests the economy is still running really, really well. And in fact, almost anything outside the housing sector is saying the rate hikes we've seen to date don't seem to have appreciably slowed activity, and so are unlikely to have affected businesses' willingness to pass cost increases through. I think we'll see 50.
A couple of weeks ago, a lot of economists thought it'd be 25. Now it seems to be 50's the consensus. What's changed?
Oh, it's been a flipathon this year, to be fair, over a lot of these meetings, because obviously, as always, we're not just trying to pick what we think the central bank should do, but also what they will do. And so their communication, I think, the bank's communication has moved around a bit this year, as they've also got their hands around, the big changes in economic conditions we've seen as the year's gone on.
We've heard from US Fed Chair Jerome Powell this week, and he started talking about the possibility of a recession for the United States. Is this a big admission from Jerome Powell?
I don't know whether it's a big admission. It's been for quite a few quarters, actually, in financial markets and the popular press. The recession word has been around. I think it's sensible the central bank deals with that head on and talks about it. The unfortunate reality is, by leaving interest rates at their most stimulatory level until so far into the recovery, it does raise the risks that there's a policy mistake in terms of tightening too far, because you're trying to move at the same time as trying to reassess how much impact your tightening has had.
And Powell's flagged a potential correction for the property market in America, and it looks like there's quite a few similarities between the US and Australia with property. How much of a risk is this for us?
Property is the obvious sector, I think, that responds to higher interest rates. Certainly it affects borrowing capacity. If you think about the way mortgages are offered in Australia, an increase in interest rates mechanically flows through, all other things being able to the size of the mortgage you will be able to get, and it makes sense, therefore, that the property market comes off. Market's weaker in New Zealand, the market's weaker in the UK. I think that's a pretty consistent story. It's the rest of the economy often which is holding up better than forecasters expected.
And then also this week we heard from the Governor of the Bank of England, Andrew Bailey, and he said the UK economy, the British economy, is in recession. It's more due to high inflation and high energy prices. But how much of a risk is this for our economy here?
I don't think there's any direct impact from the UK to Australia. I mean, the UK, obviously, there's this small issue of Brexit and difficulty with trade supply chains and other things, which is causing a bit of a problem literally on the other side of the world. For Australia, it's, I think, unarguable that the risks around the economic cycle go up as interest rates go up. They're probably a bit more acute this cycle because central banks have left it so late to hike. But our central view certainly is the property sector weakens, the rest of the economy weakens, but at the sort of interest rate levels that are within the market's frame, so somewhere between 3 and 3.5% as a peak interest rate, I think the risks of recession are not that high in Australia.
One phrase we've started hearing a bit more of recently is the wage inflation spiral. How does that actually work?
Poor terminology, to be honest. It's probably the first thing I would say. I mean, how does it work? Inflation pressures wage earners, they demand higher wages, which forces up inflation, which means wage earners demand higher wages. There's very little sign of that in Australia, if in fact any signs at all. In fact, I would argue, if you look at the wage price index, which measures wage rates in the economy, we can get some higher wage growth still without being a medium-term threat to the Reserve Bank's inflation target. The biggest threat is just the demand for resources in the economy is too strong, growth is too strong, it's above potential. The RBA bringing that back to potential, I think, will sustain the cycle for longer.
So do you think that term wage inflation spiral, wage price spiral, has been overhyped a bit too much?
In Australia, it's all smoke and no fire.
This week we also heard from RBA Deputy Governor Michelle Bullock. She talked about the bank's bond buying program, $280 billion in bonds over the course of the pandemic. That looks like they're going to rack up some big losses over the next few years. Is that an issue at all?
Look, it's not something that occupies my mind a lot when I think about monetary policy and the economy. Most things cost something. Most policy choices cost something. I think when we consider what was in most of our minds in March and April 2020, $10, $20, $30 billion doesn't sound like a lot to rescue a $2 trillion economy.
Next week we're going to get the CPI numbers for our economy, and we heard Michelle Bullock as well in a speech suggest inflation could actually get to 8% this year, potentially early next year. That sounded like a new admission from me this week. What are your tips for inflation for the rest of this year?
Oh, that 8% is a new number. We have a forecast in the 7s. Most people, I think, are in the 7s. The bank in their published forecast seems to be consistent with that sort of number. I'm worried less about the peak, to be honest. The question to my mind all the way along is focusing on the peak gets you thinking about the wrong things. I think the question really is, where do interest rates need to be to bring inflation back to target and keep it there on a sustained basis? And I think where they are in Australia at the moment is still too low.
Yeah, when are we going to actually see that big impact from these rate increases on mortgage holders? When are we going to see a crunch in people starting to stop spending as much money as they currently are?
Well, of course, for businesses, retail sector businesses, they're quite happy that consumers are continuing to spend. We have seen a bit of a shift away from discretionary spending as people's interest bills have gone up, and of course, as energy prices have gone up, and that's taken a larger share of people's income. But also it's worth remembering that the housing sector in Australia came into this tightening cycle perhaps with the best balance sheet conditions we've seen in 15 years, perhaps longer. That means it's going to take a little while for that effect to show up.
Another thing's been high energy prices due to the war in Ukraine. That looks like it's not stopping anytime soon. So how much pressure is that going to continue putting on Australian consumers and inflation?
Well, in fact, global oil prices have come off a reasonable amount, more than 20% from their highest levels, but the Aussie dollar has also gone down. So in Aussie dollar terms, we haven't seen the benefit of that. And this is part of, I think, where the Fed's tightening cycle is complicating the task for other central banks like the Reserve Bank of Australia, because it's driving the currency down, which is adding a bit of inflation at a time we could do with some efforts going the other way.
Yeah, the dollar's almost at near 2-year lows or a bit over that. So what are some of the risks for us with the dollar being at that level?
I don't know that the risks are that big. And in fact, in trade-weighted terms, if we try and take out the influence of the US dollar, which is pretty rampant at the moment, the Australian dollar has been much more stable in trade-weighted terms. So a lot of what you're seeing in Aussie weakness is US dollar strength, but it does add to inflationary pressure to the extent a lot of Australia's imports are priced in US dollars, and we get that currency translation, which is tending to keep prices higher than they might otherwise be.
Richard Yett, Senior Chief Economist at ANZ Bank. Thanks for your time today.
Thanks very much.
Cash is in decline. It's even becoming rare to see people paying cash for simple items like a coffee or a loaf of bread. And this trend has been supercharged by the COVID pandemic. The central bank itself announced a number of changes this year to keep cash in circulation. And the recently proposed merger between two of the largest cash-in-transit businesses reflects just how much pressure the industry is under. Ingrid Willinge reports.
Cash is king. Or is it?
I think at the moment we're seeing, roughly 97% of people are shopping online. About 2/3 of those are shopping online at least once a week.
The recent proposed merger between Armaguard and Prosegur is reflective of just how little consumers use cash in today's economy. The merger would see the two largest cash-in-transit companies create a single player to hold around 90% of the market. As documents are lodged with the ACCC to justify the merger, Armaguard is clear its competition is not Prosegur, but digital payments. This is on top of the RBA last month confirming declining volumes of banknotes being transported and processed has put pressure on the wholesale distribution network. If cash was scarcely used before, the pandemic has made digital transactions almost compulsory.
And what COVID did was really accelerate a shift from cash to electronic payments. And now electronic payments starts going into, well, you can obviously tap your card, but a lot of people started tapping their mobile. But then what we also saw was a lot of people going online because you're stuck at home, so you then had to shop online. So there's been massive shifts in the way Australians have paid, and it's actually had big impacts on Australian merchants as a result.
Some stores refused, and still do, to take cash payments for hygiene reasons. But customers also spending a disproportionate amount of time at home, and with many shops closed during the lockdowns, consumers' only option was online.
Typically, you'll find a younger, especially when you start talking electronic payments, it starts with younger demographics. What COVID did is it actually pushed it all the way through. So it's actually everyone is doing it now. If you go back a couple of years and you're trying to look at a store and someone tapping on a terminal, they usually use a card. But now most people are using a mobile. But everyone is doing it. And you also hear stories about online has also seen a shift from younger demographics to now everyone's shopping online. So big changes.
This acceleration of the trend has led to lots of new competitors in the payments space too.
Yeah, I think over recent years we've seen the emergence of a whole range of fintechs that are providing payment solutions in the payment space. So certainly there's been an increase in the number of options that are available to consumers.
And EFTPOS also bringing competition through its secure online payments capability too.
Actually, we're seeing about 200% growth month on month at the moment in millions of transactions. So we're not, we've been in processing online for a while, but we've seen massive take up in the recent months, and the pipeline looks really strong. So that competition we're bringing to online will help reduce the costs for businesses, and that's what's driving it.
In the digital age, a lot of shoppers aren't even carrying cash. In fact, lots aren't even carrying credit cards these days. They're mainly using this.
And there's plenty of innovation within smartphone payments too. Hello Clever is one of those fintechs which is seeing demand from private equity. In fact, it recently raised $4.5 million in a seed funding round.
We are a payment platform that embedded into retailers, e-commerce websites or any of the back-end systems to help them to receive capital instantly and also help them to create loyalty and rewards amongst their customer set. So Hello Clever also works with retailers to send them a new set of customers that, really smart and really clever and really obviously, young, wanted to spend and get instant rewards, being cash back.
You see, it's all about convenience, and even if consumers want to go to the shops physically, PayPal Australia's MD Peter Cowan says there's an increase in people actually visiting the store physically, but then making a purchase on the spot online.
In the past, people kind of used to do their research before they went shopping, then they'd go to the shop as that last mile to actually pick up goods. What we've seen now is that many people are actually in the store actually checking prices or doing their research when they're actually shopping. It's around 20% of people, but if you actually go down to those younger millennials, it's almost 40% of people that are actually doing that. And many are actually making purchases off a competitor while they're in a store browsing.
The RBA acknowledging the move towards digital and just last week announcing a process known as least cost routing can now happen on mobile wallets like Apple Pay, meaning it will be even easier for merchants to choose what cards they accept and even more access for the consumer. It could save the economy hundreds of millions of dollars. This leaves a big old hole for those businesses who deal in cash. That cash has to be moved, secured, stored. It includes trucking, counting centres, and with demand waning, it's a very costly exercise. Still, the question here is, will cash die out in 10 years? Will the humble $5 note or 50-cent coin be discontinued? The RBA for now says it will ensure that cash continues to be available to those who want to use it.
Coming up after the break, I sit down with Robert Millner, the chairman of a range of ASX-listed companies. One of them, Soulpats, beat the market by 20% this year. We'll hear his secrets next. Welcome back. Robert Millner is the chairman of investment group Washington H. Soul Pattinson, Australia's second oldest publicly listed company. It has large stakes in Brickworks and New Hope Coal, two other companies that Millner chairs as well. I had a chance to sit down with him this week to talk about his busy schedule and the challenges he sees facing business. Robert Millner, thanks for your time today. Can we just start by you talking through how many chairmanships and directorships you've currently got?
Don't tell the Shareholders Association this. I think I'm chairman of 4 public companies and sit on the board of another 3. You've got to bear in mind, a lot of those companies were within Soul Pattinson, so I'm not doing any more than I was probably doing 20, 25 years ago as far as having meetings.
How big is your workload?
Oh, I'm in here most days. I do a fair bit of travelling, obviously, but Brickworks have just opened up operations in America, so I've been over there twice this year, and various operations around Australia, so I've got a pretty good life.
Yeah, let's talk Brickworks. Its results came out this morning. Pretty strong result from the property sector in particular. Is that the main growth prospect for Brickworks?
Yeah. We've got a very good joint venture with Goodman Group, and Greg and his team have been very good supporting us. We put our land in and then they go and find the various tenants. So we've got a vast range of tenants in there, from Amazon to Coles to Woolworths to those types of top clients. So, and we're very fortunate where most of our large land holdings are in Sydney and Melbourne, and they're on the big freeways. So this day and age, you can't have a B-double running down Parramatta Road. So all these big industrial estates now are starting to be formed on these major freeways.
How much free land have you got left in those areas to develop?
We had about 1,200 acres out at Wargrove, which is on the M7, M4. There's only about 150, I think, of that still to be developed. So as you can see, we've developed a lot of it. There are a couple of creeks that run through there, so obviously we couldn't develop the whole area. And again, in Melbourne, we've got some very valuable land on one of the freeways out at Craigieburn.
And the value of that land, how scarce is that land becoming?
20 years ago, you'd be driving to work and you'd hear the traffic report. There'd be cattle on the road at Wargrove, and they were our cattle. So within 20 years, we've got these massive industrial sheds there with a property portfolio worth over $1.5 billion. So it's amazing how it's grown over that period of time.
And how long-term are the leases with those big clients you've just talked about?
Mostly 20 years CPI adjusted. And we're now starting to see the old ones 15 or 16 years ago were single storey. We're now starting to see the Coleses and the Amazons going 3 and 4 stories high. So I think we might even go back to the original ones when their leases expire and probably redevelop those and add on to the top of them, because obviously land's scarce.
Brickworks Australian business lodged a bit of an impairment today with rising costs and inflation, supply chain issues. Can you just talk us through, are those really the big challenges you're facing at the moment?
Well, obviously the world's seeing higher inflation, higher interest rates. We haven't been affected as yet, but we have been through a period of very, very high material costs. Steel and timber, for example, were 50% higher than they were 12 or 18 months ago. We've all seen the various news reports about shortage of labour, and obviously COVID has knocked us around as well. But we're confident at the moment. We've got a stream ahead of us, but if interest rates keep going up both here and America, obviously eventually we'll start to see some slowdown.
Do you think that would mean less demand from your customers as rates keep rising?
Well, obviously it's a difficulty for people. Their interest rates go up. Affordability. It's all about affordability, and this is why we're seeing a lot of people moving out of Sydney and Brisbane, Sydney and Melbourne, for example, going to places like Tassie and regional New South Wales and regional Victoria.
But the actual business itself, providing bricks for the construction sector, that still seems fundamentally strong.
Yeah, well, bricks have been around for hundreds and hundreds of years. You've only got to go to Europe and see the roof tiles and the bricks. They've been there, as I said, for hundreds of years. So it's a very strong product.
Washington H. Soul Pattinson results were out too. How do you beat the market by 20%?
Well, this is an unbelievable cycle we're in now, particularly in the coal mining. 25 months ago, which is August 2020, thermal coal was $48 a tonne. This morning it's US 440. And we've seen what's happening around the world with people closing down coal and gas-fired power stations, and no new developments of these resources. And what's happening in Ukraine, we're seeing a real squeeze on energy. I think going forward there's going to be some people hurt along the road. This is going to be a very major problem the world's going to face. We saw 2 weeks ago in Poland massive demonstrations in the street. We're having problems importing product out of Europe for brickworks because the factories are closing down, paying $100 a kilojoule for gas. So it's not sustainable.
Yeah. What are some of the adjustments you made to your investment portfolio in the last 12 months?
We've got our three major investments, which are TPG, Brickworks and New Hope. We've expanded that. We've spent quite a bit of money, a few $100 million into rural property, into citrus and macadamians, and we've obviously bought quite a bit of water. We're doing quite a bit of debt financing. We've got into swim schools. We started up some swim schools, and we're looking at a couple of bigger businesses in New South Wales to add to those ones that are based in Queensland. And we've just bought a business called Lamp Control, which we used to own 45% of, which is does a lot of manufacturing for longwall mining equipment, and also does a lot of generator work, and also it's venturing into renewables. So we've got a very good team of people here, and they're doing an excellent job, so we're able to keep growing.
And how confident are you feeling as a chairman right now of a number of companies with rising costs and inflation and rising interest rates?
As I mentioned earlier, I'm not quite sure how people realise the inflation and interest rates going up and energy. Yesterday at the Brickworks board meeting, we were informed that wooden pallets have gone from $20 to $22 to $50. So 1 month alone in our masonry division, we've had to pay $400,000 extra for wooden pallets, and this is just one little side. You've got electricity and energy and all these other costs, labour costs. I think we're in for a bit of a slowdown.
You're also chair of New Hope Corporation, had some pretty strong results this week. What's the outlook like for the coal sector?
As I mentioned, coal's at 440 this morning US. There's phone calls from Europe every day. Can we get a shipment of coal? I think in the near future we're going to see these prices up around these levels for a while.
You're also on the board of Tuas. How tough is it going to be to crack the Singapore telco market?
We came in there. That was spun off from when TPG merged with Vodafone. We'd already sort of made some inroads into Singapore, so we floated that business off separately. David Teo is in charge of. He's the chairman of Tuas. We've now got about 7% of the market in Singapore. We made 15.5 million EBITDA last financial year. We doubled our subscribers. We're in a very similar situation over there what Vodafone is here. We're very reliant on foreign workers and tourists in Singapore, and of course with COVID and lockdowns, we're just starting to see that emerge, and sales are starting to really pick up there. So I'm very confident we can grow that into a reasonably sized business.
And what are your priorities for the next 12 months?
Keep growing all the businesses while we can. We're going to have some headwinds. Soul Pattinson usually does better when things are a bit tighter. Coal mining's going to be on our side for a while. TPG is emerging with the merger of Vodafone. I'm very confident we can keep growing that. And the land and development side of Brickworks is going to continue to grow. Robert
Millner, thanks so much for your time today.
Good to talk to you. Cheers.
There's been a fair bit of mining news this week. Fortescue Metals announced plans to decarbonise by 2030. The Oz Minerals Board has given final investment approval to a new copper and nickel mine, and coal prices have kept rising sharply. Let's bring in Peter O'Connor, mining and metals analyst with Shaw and Partners. Peter, thanks for your time today. Let's start with Fortescue Metals' plan to decarbonise by 2030. How ambitious is this strategy?
It's world leading, Ed, so it's a big deal. And the announcement they made on Tuesday, they tried to present it just in that way, that they're ahead of the curve. They're setting a benchmark for their global peers. So the 50 other companies that joined this US initiative called the First Mover Coalition, they're leading that as well. So 2030 is an exceptionally ambitious target. But in true Fortescue style, the way they built the mine back in the late 2000s, it's possible. And they're probably the company that could deliver that. But it's certainly going to be a challenging 7-year period to get there.
Yeah, I spoke to the chairman of Fortescue Metals, Andrew Forrest, a bit earlier this week. I just want to play you a little bit of that conversation where he talks about how much green energy they're going to need to be generating for their mines.
Yeah, the green hydrogen that we need, we will generate ourselves. You remember, Ed, you're talking to the company who's building the largest electrolyser facility in the world. You know, you can buy an electrolyser now for 25 megawatts. We're building out a 2,000 megawatt facility in Queensland per annum. So we know, of course, where to get the water from, where to get the energy from, but the catch here, Ed, is the electrolysers, which are decisions we took over a year ago, we funded over a year ago, and will be ready next year. So we've really prepared Plan B, Plan C, Plan D before we announce Plan A, Ed.
2 to 3 gigawatts of green energy is going to be required. They're saying they're only going to be spending $6.2 billion between now and 2030. How achievable do you think this actually is, Peter?
The timeframe is certainly tight, given the backdrop we've seen across the renewable space. The capex we're still not sure about because we don't know how that will play out in what is a very inflationary environment for manufacturing any product or building any product, particularly in the Pilbara. So those two challenges and running an existing business as well suggest that 230 is an incredibly ambitious target. But again, the Fortescue style back in the 2000s, they delivered what nobody thought they could in iron ore, and what is now the best infrastructure in the iron ore industry in the world, bar none. And I'd have to suggest that Fortescue is the company that could likely do that. So ambitious, challenged, and very, very hard target to meet. But, fingers crossed, I hope they actually get there.
Look, let's also talk coal prices because they keep getting stronger and stronger. And New Hope Coal reported its profits this week up 12-fold. What's the outlook like for the coal sector right now?
It's fascinating. Old energy versus new energy. Who would have thought that old energy be where it is today? And this is not just because of what's happening in Europe and the Ukraine. It started 2 years ago when we came out of the COVID first stimulus measures back in mid-2000s. So this journey with energy, it's followed global growth and the tightness in global growth ahead of the interest rate tightening cycle just recently. And we've seen more energy units used, less energy units available to supply, and prices higher. And the Ukraine has just dialed that up another notch. So from here, heading into a northern winter. We've just seen Russia talk about mobilising again in Ukraine, so potentially no sign of a withdrawal or a lessening of tension there. So sanctions to stay in place. Redistribution of global trade flows in energy, be it gas or LNG or coal, means that the market will be tight for the foreseeable future. So post-winter at least is the earliest we'd expect to see prices get back to some form of normal level. So energy, coal, LNG, gas will continue to trade higher against that backdrop. So, and we haven't even really hit cold weather just yet. So the market's going to stay firm for the foreseeable future.
BHP a couple of months ago announced plans to close their Mount Arthur coal mine by 2030. That's in the Hunter Valley, and it seems to be a lot earlier than expected. And I had the chance to speak to Rob Bishop, the head of New Hope Coal, about that mine. Just take a quick listen to what he said.
I think that mine closing, that mine is very similar to Bengala quality coal. It's low emission, high energy coal, which Australia is one of the key suppliers for. Colombia is another one, and so is Russia. So, with what's happened in Russia, That's taken away a lot of good quality coal, and that's what the world needs. Low emission, low ash, good quality coal, rather than a lot of Asian countries which produce high ash coal, which doesn't have as much energy, and you need to burn a lot more for it. So, by closing down or sterilising all of that resource there, it just means that the world's going to have to push to other sources, which will be of a higher ash nature, which just isn't good for the transition away from fossil fuels.
Now, Peter, Rob Bishop doesn't specifically say it there, but I'm sure New Hope would love to run that mine from 2030 onwards. But do you think that mine should have a chance to continue operating until 2045 when it's supposedly meant to be wrapping up?
Well, again, go back to the comment about old energy versus new energy. That transition will take longer, and not least because of what's happened in Europe this year. So we do need to look at units of energy, high quality, lower emission energy, such as that from Mount Arthur North. And given New Hope has effectively circled Mount Arthur North's leases, they're the logical owner of that lease and operator of that lease from 2030. So both companies, BHP and New Hope, make very valid points. BHP was more about the stewardship of the closure of the asset in a responsible way over a multi-year period. It's somewhere in excess of a decade to close that mine properly and to rehabilitate the mine site. So it needed the correct company to run it. So in terms of economics, based on where we are today versus a year ago, the mine could keep running to 2045 and generate a substantial amount of cash. And with the right owner and the right outlook, could close that mine appropriately in the 2040s decade. So the likelihood of it staying open longer is obviously more likely given where coal price is today and more likely to continue into the future. And the forward curve for coal price suggests that at the least, coal prices will be no more than half of what they are today, which is still a price probably 3 times what they were historically. So the market's more buoyant, the outlook's better, the cash flow generation's better. So a New Hope logical fit for the company. And in BHP's case, their view is right as well. It just depends on the price backdrop that you use to get there.
This week as well, the Oz Minerals Board have approved the green light to a new mine, the West Musgrave project, copper and nickel mine. How important is this mine going to be for the Oz Minerals company?
It's been one of the biggest drivers of their future growth profile, but it really hasn't been valued by the market until about 1 year ago. So actually the genesis of this idea and the genesis of the shareholder creation from this idea is not today, not a year ago. It's going back 5 years or more when they first got interested in a company called Cassini Resources. Cassini picked up this asset from BHP for almost nothing, and Oz Minerals then picked up Cassini for almost nothing compared to the value of the asset today. So the value creation steps taken, they go back to 2015. Today is the embodiment of all the work they've done to get it here, but a major mine, long life, low cost, a super high level of renewables in terms of the supply of energy, and fitting into what we call the future-facing industries of nickel and copper. So well-placed, well-timed, and probably one of the best companies in the world to deliver that project, given the way they assess, analyse and deliver projects. So Oz Minerals, key part of their growth profile, and by 2025-26, their compound growth of their top line will be one of the best in the copper industry globally, largely driven by what's happening at West Musgrave. So today's announcement's a big step, but again, the foundation's put in place quite some time ago.
And just quickly, Peter, BHP offered $8.4 billion for Oz Minerals a while ago. Do you think they may increase that offer now that this project is definitely going ahead?
Yeah, there seems to be a little bit of gamesmanship going up here with timing of announcements and timing of bids. So, yes, if BHP wants to get invited into a data room, the Oz Minerals management haven't given a number, but they've intimated that it's substantially higher than BHP's $25 number. If we look where Rio Tinto has bid for a company in Mongolia called Turquoise Hill and look at those relativities of pricing, a number with a $3 or $30 starting point would be where BHP would need to be to likely get the attention of Oz Minerals Board. And I think that would be necessary for BHP to move this further. So we do think BHP's got at least another bid or more in them. At the next step, maybe $30, it may be less, but to get the company, to get inside the company, to do due diligence, and then to make a full and wholesome bid for the company, it would likely need to start with a 3. So we're expecting a number, mid-low 3s to get it to BHP, and that's still probably some way away. But at that point, you maybe go out to a global data room with some contestability across the board. But so BHP is certainly at least 1 or 2 more steps to go from here.
Well, Peter O'Connor, mining and metals analyst at Shaw and Partners, thanks for your time today.
Thank you very much, Ed.
After the break, Stockland's Chief Executive Taryn Gupta outlines some of the big challenges facing Australia's property sector, and we also recap the 70-year history of Stockland that started out in Western Sydney with just 19 apartments. Welcome back. Rising interest rates are starting to push down property prices, and that's putting pressure on companies like Stockland, Australia's largest listed property developer. But it's faced plenty of challenges before in its 70-year history. I caught up with its Chief Executive, Taryn Gupta, earlier this week.
Yeah, well, Stockland's Australia's #1 residential developer. We've got the largest portfolio, and we deliver about 6,000 to 7,000 homes a year for everyday Australians. And we're also the largest diversified property group on the Australian Stock Exchange.
This year's Stockland's 70th anniversary. Can you just explain the history of Stockland, founded by Irvin Graf back in 1952?
Yeah, Irvin founded the company 70 years ago. Irvin was an immigrant from Hungary, and he had a vision he had a purpose in mind, which is to provide everyone with better ways to live. That's our purpose that lives on today. And the company started 70 years ago with 19 affordable homes in Sefton in Sydney, which were fibro homes, and that affordable homes and shelter and a place to bring your family up in a community remains true to our purpose even today.
And how quickly did the company evolve and move into the retail sector and then be listed on the stock market too?
Yeah, well, the company had many milestones. Once we started to get into community development, Irvin realized very early on that to create the community, you needed shopping centres, you needed childcare, you needed schools, and that's how we started to get into retail and started developing our own shopping centres, which are here with us even today here in Sydney. Shopping centres like Maryland go back a long way. And then really the company evolved over the following decades into a diversified group playing in almost all parts of the property market.
And it looks like Irvin was at the helm of Stockland for quite a long period of time.
Yeah, he was till his, he passed away early 2000, and he ran the company over that time as CEO and then as chairman as well. And there was Peter Daly, who ran the company as CEO when he was chairman.
And you joined Stockland in June last year. How's it been leading this company over the last year and a bit?
Well, firstly, it's a privilege. I'm only the 5th CEO for Stockland in 70 years, so it's an absolute privilege to be leading this great organization. It's been fantastic. It's been 12 months. We've been executing on our refresh strategy. We've been reshaping our portfolio. We've sold some businesses, and we've acquired businesses in the land lease sector. The company is positioned well for the future.
Just talk to me a bit about your background coming to Australia as an international student in the 1990s. How did that shape you into who you are today?
Yeah, a bit like Irvin, I'm also an immigrant to this wonderful country. I arrived here in 92 as an overseas student to do my postgraduate studies, and really loved the Australian community and the Australian way of life. And here I am after 30 years. Still here, really, I've been part of the community, and I've got my family here, and just contributing back to our wonderful country is what drives me, but also what drives Stockland.
What really attracted you to working in the property sector?
Well, I think property is very tangible. The things you work on really do impact people's lives in a positive way. So it's great to get a greenfield piece of land and then imagine what product you're going to put on it, whether it's communities, homes, shopping centres, offices, and then after a few years seeing the community come together and enjoy those facilities. That satisfaction you get from that is, I think, why most people never leave the real estate sector.
And looking at the property market right now, what do you see as some of the biggest challenges facing people that are looking to get into the market?
Yeah, that real estate has always been a cyclical business. There's macroeconomic factors that impact demand and supply. We've had a great run in the Australian housing market last 3-4 years, but with rising interest rates, affordability is becoming is more challenging, and that's slowing some of the demand. But the underlying fundamentals for real estate and for housing in Australia remain very solid. We've got an undersupply of housing. You're seeing rents rise because there's an undersupply. And now we've got immigrants and overseas students coming back, which will again provide a demand underpinning from a fundamentals point of view to the market. So we remain very positive about the medium to long-term outlook for the market.
Rental vacancies around 0.9% across Australia. How big an opportunity is this for Stockland?
Well, Stockland is already playing in the build-to-rent market in our land lease business, a business we've really ramped up in the last 12 months. That business provides really a great affordable option to the retiring or aging population of Australia, the 55 plus demographic. So we're playing in that. We've got almost 10,000 homes that we will be bringing to the market in the next few years. And we are also very supportive of the build to rent or more multi-family rental product, because it provides, again, diversity of housing. It provides for people who are looking to buy but are not quite ready to buy very high quality rental options. So we remain very supportive of diversity of housing right across the economy.
The Reserve Bank this week said they're expecting Australia's property prices could fall about 15%. What sort of modelling are you seeing at Stockland?
Yes, see, our business really is on the supply side. We play in the new home market where we supply very affordable homes to first home buyers. So we look at that part of the market. That market is usually very resilient as you go through the cycle in terms of pricing, because unless you have an oversupply of inventory, which this cycle we actually don't have, because of prolonged construction programs, we have no inventory in the market. We don't see as much price pressure as you see in the established home market. We anticipate, if you look at last 3 to 4 cycles in the new land market, price corrections are more like 5 to 10% is what's the norm. It's more that volumes come off their peaks up to 50% through the cycle, and that's what we would anticipate as the most likely scenario.
Mortgage stress, is that becoming a bigger issue now that interest rates are rising?
Yeah, affordability generally in markets like Sydney and Melbourne, particularly in Sydney, is a key issue because we had such strong price rises. But that should start to moderate or come back as prices correct, but also wages rise. We've got wage rises taking place of around 5% per annum at the moment. So we do anticipate over the next 18 to 24 months, the affordability will improve in the market. The biggest issue for buyers at the moment is interest rates and their trajectory, because the RBA cycle has not quite finished. Buyers are a bit cautious in the near term, just wanting to see where the interest rates stabilize. That's probably the main issue at the moment.
The other thing is retail spending. It keeps setting records each month, but as interest rates rise, that's expecting to come off. So are you expecting there to be a bit of a retail crunch?
Well, we're seeing very strong retail sales, like a number of other owners of shopping centres. As at June, our sales are rising at about 8 to 11% range across our shopping centres. We see that continuing for the rest of the year. You've got to remember, we've been locked up for 2 to 3 years in COVID. Now people are out and about buying new clothes and new goods and spending that money. Our savings rate is very high in Australia. It's starting to moderate. So we do see a good short-term outlook. But eventually, over time, some of the discretionary spending will come off because of the rising cost of living and rising interest rates. However, our portfolio is predominantly based on everyday needs. It's supermarkets, essentials, those sorts of product account for 75% of our retail portfolio. So we see that being much more resilient in this outlook.
Tarun Gupta, Chief Executive at Stockland, thanks for your time today.
Thank you.
American telecommunications company Verizon has had a presence in Australia for about 25 years. It serves more than 75 Commonwealth and state government agencies and is very active in cybersecurity. Ross Greenwood caught up with the Verizon Business CEO, Sampath Sowmyanarayan, a little earlier.
Yeah, look, the Verizon Business Group is north of $32 billion. And we are exclusively focused on serving global multinationals as well as small businesses here in America. We also do serve a lot of the large public sector customers, whether in the US or in Australia. So a global business, 120 countries and growing.
So in Australia, much of your business traditionally has been with government and with very large businesses, also with defence as well. Can you just explain that side of your business?
Yeah, look, Australia business is kind of at the cutting edge of what we do. As you said, we serve large multinationals out of Australia, but also more than 75 Commonwealth and state agencies where we do work. The bulk of our work is very advanced cybersecurity. We run a security operations center, what we call a SOC, out of Canberra. And there we serve some of the most complex cybersecurity needs in Australia. And we've been doing that. Our presence in Australia goes back 25 odd years, and we have hundreds of Verizon employees based out of Australia.
So another important aspect for Australia is our security in this region. Famously, Australia banned Huawei products from participating in the 5G telecoms rollout. Your company, Verizon, has been allowed to participate in those rollouts.
Look, where we operate in Australia is primarily on running large, complex global networks, as well as running cybersecurity operations in doing that. And part of this comes from the fact that Verizon, at some point in our network, more than a third of the world's internet flows through our network. And as a result, we tend to see events, we tend to see anomalies way before most other people tend to see them. Now we take some of the capabilities we have and then bring them to Australia. Now, one of the things we like is, Australia, as it gets into its geopolitical partners, whether it's the AUKUS or the Quad, there are a few set of countries that Australia can work very closely with. US is in that list, and we are part of the solution there, Ross.
So given the fact that even in our region in recent times, there have been suggestions Huawei might be allowed into some of our neighbours' networks, despite Australia seeking to keep Chinese influence out. Is this important regarding the Quad security from Verizon's business point of view?
Look, we strongly believe in supplier diversity, but more importantly, we feel there is supplier diversity with other partners. We work closely with Ericsson, with Nokia, with Samsung for rolling out 4G and 5G as well. We in the US and Verizon have no Huawei equipment within our environment. We do not connect to Huawei equipment. We do not support Huawei equipment because we feel there is enough in the ecosystem that supports our security needs.
But of course, this is not just at the very high level. It also goes all the way back down to individual businesses. You, in your business, have made reference to Verizon and pizza shops, for example, because at every level of commerce, there's a security risk, and that's a part of what you help to fix for business.
Ross, what's interesting is 9 out of 10 cyber attacks that happen because of cyber crime syndicates. 1 out of 10 is either a state actor or another industrial actor trying to work its way. But 9 out of 10 cyber attacks are driven by single thing, money. It's quite a lucrative business for those who can have it. So there's a lot of emphasis on small businesses getting the right hygiene in place, getting the right technology in place to lock it up. Now, it doesn't always involve James Bond type stuff. It involves very basic things. Have a password, change your password often, make it complex, put your patches, upgrade them often. So basic blocking and tackling hygiene goes a really long way in protecting small and medium businesses in the cyber space.
So here in Australia, we've got a number of telecommunications companies, Telstra, Optus, TPG. Now, Verizon, I know, does have 5G networks in the United States. So do you have aspirations to roll out a network here in Australia?
Ross, Verizon is not going to operate public 5G networks in Australia. We do not have spectrum. We do not intend to purchase spectrum. But Verizon will definitely take a part in the private 5G ecosystem. These are private networks that are built around venues, ports, airport, logistics center, warehouses that are designed to operate securely with very low latency. We've done a lot of global deployments of those private 5G networks, and Australia is definitely on our roadmap as we deploy them.
Sampath, many thanks for your time. Great to talk to you.
Ross, thank you so much.
That's all for the show this Sunday. Up next is all the latest news right here on Sky News. Business Weekend returns next Sunday, and Ross Greenwood will be back hosting again. It's been great hosting the show for the past few weeks. Don't forget, you can keep up with all the latest business news with our daily program Business Now at 4:30pm and 10:30pm Eastern Standard Time. Thanks for your company. I'm Edward Boyd. We'll see you tomorrow.